Good morning, everyone. We would like to officially welcome you to the 2021 Joint Mutual Forum hosted by the FDIC and the OCC. I'm Rayanne Miller. I'm Senior Deputy Director in the Division of Risk Management Supervision for Supervisory Examinations and Policy. We know you took time out of your busy schedules to be here, so we really do appreciate it. We want to make sure that you're going to actively participate today. It's a little challenging with these virtual meetings, but hopefully we're all used to this by now. And so we really want you to encourage you to ask questions throughout the session on any topic of interest to you, particularly in your role as mutuals. So I want to go over a few operational items. Given the size of this virtual group, if you would like to ask a question, kindly type your question in the Q&A box located in the lower right-hand corner of your screen. And also, if you would like to activate the closed caption function, click the three dots in the lower right corner of your screen, and then click on the button that says Multimedia Viewer. We are going to be recording this event, and we will be posting it on our website, the FDIC's Mutual Institution website, in a few weeks. So just a few minutes to provide you an overview of today's discussion agenda and the materials that we sent you in the packet via your email. You'll see that we're very lucky to start our day with a conversation with the chairman of the FDIC and the acting comptroller of the currency. From there, representatives from the FDIC and OCC will give us an economic outlook and industry performance review. And then after a short break where you can grab some lunch, we're going to have an update on the supervision of mutual holding companies by representatives of the Federal Reserve. After lunch, my friend, Deputy Comptroller Mike Brickman at the OCC will guide you through the afternoon session, where we're going to hear from a banker panel about the strategic benefits of mutuality, followed by a panel of bank regulators who walk you through an anatomy of a ransomware event. Later in the day, we're going to split off into two sessions, where you'll have the opportunity to engage with your bank supervisors. Federal Reserve member banks are free to attend either session if they choose. In addition to the agenda, in the email, you'll find speaker biographies and a handout of cybersecurity resources. So we hope that you find the forum productive and informative. I'm going to briefly just acknowledge the Mutual Forum Planning Committee that helped make this day happen. From the FDIC, Marianne Hathaway, Patty Colahan, Karen Curry, Heather Bassnett, Alicia Marks, Shannon Grieco, and Bernie James. And from the OCC, Charlotte Ban, Mike Brickman, Barbara B.J. Jennings, and Carlos Rodriguez Morales. So thank you all, and all of our volunteers today on the panel. And most importantly, we appreciate the support from our senior management and the chairman and the acting comptroller. So without further delay, I'm going to introduce our first panel with our featured speakers, my chairman, Chairman Jelena McWilliams. Ms. McWilliams was sworn in as the 21st chairman of the FDIC on June 5th, 2018. Prior to joining the FDIC, Chairman McWilliams was the executive vice president, chief legal officer, and corporate secretary for Fifth Third Bank in Cincinnati, Ohio. She also worked for the U.S. Senate Committee on Banking, Housing, and Urban Affairs for 6 years as deputy staff director and chief counsel. Michael Hsu became acting comptroller of the currency on May 10th, 2021. Prior to joining the OCC, he served as an associate director in the Division of Supervision and Regulation at the Federal Reserve Board, supervising globally systemic important banking companies operating in the U.S. Mr. Hsu has also served as financial sector expert at the International Monetary Fund, financial economist at the U.S. Treasury Department, and the Securities Exchange Commission. And you'll be interested to know that both my chairman and the acting comptroller were attorneys at one point at the Federal Reserve. We also have as our moderator a very distinguished banker, Annette Russell. Annette is the president and chief executive officer of Security Federal Savings Bank, which is a $320 million federal mutual savings association in Logansport, Indiana. She joined the bank in 1991, and it's great to see careers with banks for such long periods. She's a CPA. She serves on the American Bankers Association Community Bankers Council, and recently served as the first female chair of the Indiana Bankers Association. Annette's very active in her community. You could read her biography about a number of awards she has received. So without further ado, Annette, please, I turn it over to you to start the panel.
Thank you, Rayanne. And I am so honored to be here this morning to moderate this session. I am a banker. I am not a moderator, but just how humbling it is to be in the presence of Chairman McWilliams and Acting Comptroller Hsu. We're so glad to have you here today so that we can express our gratitude and to get your insight on the future of the mutual bank industry. So we already have some prepared questions and encourage all audience members to submit questions through the chat function. If you have something that comes up throughout the next hour that you would like directed to either Chairman McWilliams or Acting Comptroller Hsu, please do so and we'll make sure to get your questions answered. And thank you for joining us today. We'll go ahead and get started. The first question will be directed to Chairman McWilliams. You have been in your role for 3 years now, and I'm sure that your priorities with the FDIC and community banks in general has evolved over that time. Can you tell us what your priorities are today for the FDIC and in particular for community banks like mutuals?
Oh, great question, and thank you so much. And Rayanne, thank you for that kind introduction. You know, Mike and I have been trying to hide the fact that we were both lawyers at the Fed, but I guess now the truth is out, and I don't know what's going to happen. I'm sure he was a much better lawyer than I was. So you're right, Annette. This is my third year at the FDIC. I just celebrated my third anniversary very quietly. But I remember 3 years ago, actually, it was one of my first events was this event. And this was my first foray into kind of the thinking about mutual banks and how we approach them. And it was fortunately very early on in my tenure as chairman. And I will tell you this, when I first came to the FDIC, you know, I took about 6 months to learn the agency. You know, I knew the agency from my time on the Hill, on the Senate Banking Committee, and when I worked at the Fed, but I wanted to learn it from inside out. And I wanted to understand how do we do things. You know, one of the first things we did was basically go with a Trust Through Transparency initiative, which was basically putting more of our information, including quantitative metrics, out there for regulated entities and for the public to see, including, you know, the number of days it takes from the time you the examiner leaves your bank until you get the examination report, if you're a 1 and 2 rated bank versus 3 and 4. So that gave people a little bit of a sense of how they're doing as they're awaiting the report. And then we also put out some of our examination instructions and manuals that were previously not released. So that was transparency and accountability have been really, really important to me as chairman. And then I tell you what happened. You know, we were looking at some of the regulations that need to be updated. You know, we had early on, we engaged with the CRA and the Fed on the Community Reinvestment Act, and we looked at the broker deposits. We revised those last year. That was just the FDIC rulemaking. But the pandemic did change something. And, you know, you ask how did the priorities evolve? And I would say that, you know, for better or for worse, last year, you know, my focus of innovation that I had even before the pandemic just got really exacerbated. Like we realized pretty quickly we had to do everything off-site, everything online, including from doing our work to examining banks. And that has shown to me that innovation is going to be critical moving forward. And, you know, back, I want to say it was October of 2018, I gave a speech at the St. Louis Fed on the future of community banking and talking about technology and innovation and how that is really what's going to decide on the survivability of community banks, including mutuals, investing in new technology, getting rid of the legacy systems that are going to frankly become a liability for a lot of these smaller banks. I know it's expensive, but we have to work together on this. We created FDI Tech, our Office of Innovation, to help banks with that. But really last year, I would say it showed us that innovation for community banks is no longer a question of shall we not, but how can we do it because we must. And so I would say that would be kind of like probably the primary evolution of my thinking on, you know, innovation being one of the tenets I wanted to address to moving it truly to the front of the pack.
Great, I agree. And I know we're going to talk some more about innovation here shortly, so I'll be anxious to hear more of your insight. And Acting Comptroller Hsu, You recently provided an outline of the priorities that you wanted to work on while at the OCC. Could you give us a little more detail around those priorities?
Sure, I'd be happy to, and thank you and Rand for the very kind introductions for this very important forum. So there are 4 priorities I laid out, and they really align with what I think of as short to medium-term problems that have to be solved. And so the first has to do with guarding against complacency, and I think that to be more specific in this particular context, I think one thing that is important for us to kind of think through in terms of the credit cycle is, a lot of the banking industry in general, and I think mutuals in particular, have fared quite well through the pandemic. And I think that they deserve great credit for that, both kind of from a financial perspective, in terms of working from home, as Chairman McWilliams highlighted. I think it is important, though, to ask, were we lucky or were we smart? Because there's a difference. And I think that with regards to the credit cycle, the federal government and a lot of state and local governments did extraordinary things to help. Everyone did their part in a way to kind of help through the pandemic. And I think that it's important for financial institutions in particular to kind of look inside and say, well, in the way we weathered this, how much is due to smart underwriting, smart kind of relationships with our clients, kind of working with them through forbearance and other issues, and how much of it was due to the fact that the government provided enormous amounts of support and stimulus, both directly to individuals and the Fed through its various programs, because I think there is some risk of overconfidence in how well institutions fared. And I think it's good to just be clear-eyed and objective about it, not to overplay or underplay. I think the credit that's due to how well. I think it's just a recognition that everyone was pitching in, individuals, institutions, government, to kind of get through a once-in-a-lifetime trauma. And so. Coming out, and the reason I highlight that is I have seen some instances where I think that there are the risk of complacency is there, of kind of giving a bit too much credit either to oneself or to say, hey, we did such a great job, let's go back to normal, where I think that a little bit of humility around that is helpful. Now, the second priority is really around reducing inequality. I think here mutuals have done a really great job, and community banks in general have done a great job of looking out for their communities. And that's really what this is about, is that the pandemic has disproportionately impacted certain populations. I think community banks are particularly attuned to that, more so than some of the larger banks. And that disproportionate, in terms of the recovery, they are at risk of getting left behind. And so Annette, you were talking earlier in the earlier meeting about some of the things that your institution is doing. I think that's fantastic. That really differentiates, I think, mutuals and community banks from some of the larger banks, and that's important. It doesn't have the scale of the mega banks, but it kind of builds, it plays into this need to make sure that we're taking care of all Americans, not just those who have the means already. The third priority is about digitalization and innovation, and I think Chairman McWilliams has talked eloquently about this. So I'm not going to repeat those parts. I think this is a kind of a well-known issue that folks are grappling with. Maybe to add something new, I do think that there does tend to be a hyper-focus on the technology. The latest gizmo, or the kind of the shiny ball, if you will, in terms of solving problems or creating new conveniences or new capabilities. That's important. I think it's easy to lose why. Why do we have? What is the purpose of this technology? How does it help us? And how does it bring us closer together? I think that's a very important. I think that is one of the parts of technology that there's kind of there's two sides to it, which are interesting. On the one hand, it can bring people together. It can enhance economic livelihoods of folks. We've seen this in the pandemic. It can also alienate quite a bit. And I think this is something where mutuals do have something something unique to bring to the table in the way they're structured and the way that they're mission focused. That is a bit different than what I'm hearing from larger banks and fintechs, and I think that that's something kind of worth exploring a bit, especially as there's all this change going on that's facing us all. The fourth priority has to do with climate, and it's really just acting on climate change and making sure that it's one of those things that happens slow enough to ignore, but fast enough and big enough that if you ignore it for too long, the change is going to be quite painful for everybody. So I think that's something that we all need to kind of act on. We're looking at it through the lens of risk management and making sure that there's proper risk management around that. It's a big topic. Happy to talk about it more, but I just want to hit those highlights really quickly and open the door to further follow-ons later on in this roundtable.
Thank you. Thank you both very much. And I would agree that I think we're all kind of trying to anticipate how or if consumer behavior will change once we feel like we are through this period that we have experienced. So I think we're all kind of waiting to see how reliant technology our consumer customers will be. Okay, the next question, and we will start with Acting Comptroller Hsu this time. Community banks and mutuals in particular are important to the OCC and the Fdic. There will be a panel on today's program this afternoon that includes a discussion among mutual bank CEOs who will talk about how management and boards of directors are using mutuality as they work with their customers, communities, and community groups. Community service is just one example of how mutuals can differentiate themselves. Can each of you share what you think is a top challenge for the CEO of a mutual bank? And do you have any advice for mutual bankers?
I think that that differentiation is a fantastic thing to highlight. But I think my biggest advice is that communicate it, share it. I think that there is a thirst for hearing stories about how banks are helping. Banks help in lots and lots of different ways. I think mutuals, the way that mutuals are helping their communities are even more unique, and I think will get people's attention in a way that's very, very positive. And so I think part of it is do the right thing and share the right thing. Share that out with folks. And I know that within the communities themselves know it. They feel it. They see that. I think it's spreading that word a bit more broadly. I think that's why forums like this are quite positive and powerful in kind of amplifying that. Get the word out on those things because they're important. I think those are important things. I think it's important for the financial services industry to be aware of these things that are happening. And again, and then not to put you on the spot, but what you were talking in the MSAAC meeting earlier, that's great. Those kinds of stories and how it's not just what you do, it's how you think about it that I think is really, really valuable. And it's different from what people expect. And I think there's just kind of level setting on that is just really valuable and important.
Thank you. Chairman McWilliams, would you like to answer the question? If you would like for me to repeat it, I would be happy to.
Okay. I'm good. My attention span is this short, but I got it. So I will say that really the pandemic has highlighted the personal touch that community banks and mutuals in particular bring to their communities. Early on in the pandemic, it was actually March of last year, I started calling some of the CEOs of our FDIC supervised banks, and I said, what's happening on the ground? What are you seeing? And what I wanted to do was basically get a feeling from, the branches that didn't close. What are people doing? Are they visiting branches? How are they getting their money? Are they seeing any changes in the economic activity? We collect call report data, but that data is outdated. By the time it reaches us, it's like 3-4 months later. So I wanted, almost real-time information by placing those calls. And almost every single CEO, actually every single CEO I talked to, they said, we already called our customers, we're already working with top small businesses we have that with extensive lines of credit to see what they need. We want to make sure people stay in their homes. And I guarantee you, if I called any one of the much larger banks in the United States, there was no way. There was just no way, because of the size, scale, and the nature of their business model, that they were able to have that level of relationship on in the first few days of the pandemic, to be able to make calls to pretty much, and also the size, to all of their customers in a record time. So that really has highlighted to us what community banks and mutuals in particular bring to the table in their communities. Now, the transactions with customers have and will become even more reliant on technology being conducted remotely, using technology remotely. Mike mentioned working from home, et cetera. Now, when we think about what does mutuality and what does community mean, there's an opportunity for mutuals here, frankly, that I think needs to be addressed from an operational, regulatory, and customer relationship standpoints. And we want to be helpful in that process. I will say that, you ask if we have any recommendation for the CEOs and bank management. I would say that my personal ask would be to urge the CEOs to think about what is impeding their ability to innovate and to offer the solutions that would probably be better for the bank and the communities that they serve. And then to tell us, the FDIC, how can we work to tackle those issues together? We're talking perhaps, IT solutions that could be developed internally. Are they locked into legacy contracts that we could perhaps do something about or not? I don't know. But these are all the things that we're frankly willing to explore to ensure that mutuals can basically go on for another century. We during my first year at the FDIC, we had about 220 mergers, and I don't need to remind you, the economy was booming. It was the lowest rate of unemployment in recorded history in the United States. There was a rising tide. Everybody was feeling good about the economy generally. There were, of course, some classes of people that were left behind, and we're working to help those as well. But even during that time, so that's peacetime, we lost 220 banks to mergers. And so really, when I look at the end of my tenure as 5 years as chairman, we're talking about 1,000 banks, being merged into other entities. I mean, that's 1,000 banks, which is 1/5 of the landscape of our financial institutions compared to when I assumed office. So when we think about that, you won't be able to serve your community if you're not there. And when we think about, are you going to be there? Are you going to be able to survive? It's about kind of evolving to that next stage of both regulatory expectations, resiliency vis-a-vis, cybersecurity, et cetera, but also offering the technology and solutions that your customers have come to demand.
Thank you. Thank you. I think innovation can be somewhat of an intimidating term because we feel like we have to have these big brainstorms of ideas that are grandiose, but innovation, what we have found, because it's something that we've incorporated into our culture, can be something as simple as tweaking an existing loan product or adding a community space to a new location so that people have a gathering space that is something that's not common for every financial institution to provide. So I think maybe bringing that down on a smaller scale, and that it doesn't always have to be technology related, that we can generate ideas without technology, right?
Yeah, Annette, if I can just add an example, actually, because I'm so glad that people think about large projects that cost millions of dollars to implement. And frankly, that's not when we talk about innovation, it doesn't have to be there. It can be so much smaller on scale. I'll give you an example. We have an Amish bank. It functions in Pennsylvania. And what the bank was created by the Amish to help the Amish community. And because they don't use electricity, the bank basically set up a bus. It's called the Gelt Money Bus. And it goes from a farmer's market to a farmer's market. So on the day when there is a farmer's market and the Amish community is present to sell the products and services, they can literally walk to the bus, deposit the money, and they don't even have to go to the bank. So if you really think of, imagine what an innovative solution that is. And frankly, all it required was a portable ATM on a bus.
Sure. And talking to your customers and your communities, and those ideas will flow. That's simply all it takes. Okay, I'm going to move on now to the next question. And the FDIC and the OCC have been leading efforts to promote bringing more underserved consumers into the mainstream banking system. Would each of you talk about your agency's plans to accomplish this initiative? And Chairman McWilliams, if you'd like to start.
Sure. I'm happy to. This is one of my favorite topics. So when we think about financial inclusion, sometimes I share my personal story of immigrating to the United States with $500 and not being able to open up an unsecured credit card, and how painful that was in the beginning because I had no other access to capital. When I think about financial inclusion, the real question is the system working for people at all levels? Is the financial system, do they feel like they're part of the fabric of the United States financial services and banking system? Now, the good news is that the portion of banked U.S. households, meaning those that have a banking relationship, is close to 95%, which is the highest since our survey at the FDIC began in 2009. But there's always a but. There are about 7.1 million households that do not have a banking relationship. And so when we think about how do we make sure that more Americans get integrated into the financial fabric of this country, we actually have to think outside the box. And the same old things that we have done in the past as regulatory bodies is just they're working, they're moving things along, but they're not quick enough, they're not agile enough, and they're basically not reaching that last mile of unbanked Americans. So we have developed a multi-pronged, I would call novel approach to tackling this issue. It includes, again, better understanding of technological advancements that could help people who generally don't have traditional credit scores. We're talking about using alternative data in the underwriting models, relying on artificial intelligence, machine learning, et cetera. We're also working on several initiatives to facilitate partnerships between third-party service providers and banks that can allow banks to reach new customers and offer new products, including by updating our broker deposits rule, as well as we are looking to create a public-private standard-setting body, which would basically allow the partnering of the third-party service provider with the bank to be expedited. It would be almost like a good housekeeping seal of approval. This this entity, private-public entity, would basically be the certifying organization, and third-party service providers would come to that entity. They would get certified by the entity, and we would work with the entity to make sure that the certification satisfied our examination requirements and our due diligence requirements. And then they could take that certificate to a bank and say, okay, so the primary due diligence on us being approved by the FDIC as your third-party service provider has been done. So at that point in time, the bank would be able to do just like the tip of the iceberg due diligence based on its business model and risk profile, and not the first 100 items, which are probably very similar for each of the banks that the third-party service provider teams up with. And then I would say we have created enhanced collaboration with minority depository institutions and community development financial institutions to better allow them to compete in the modern era, including through the creation of a mission-driven bank fund. We're in the process of setting up this fund. It's one of those things that I like to say, stay tuned, go to our website often, but we had to jump through several hurdles. But the idea of the fund came to me on a plane. There was nothing to watch on a TV screen in front of me, and there was Shark Tank that came up on DirecTV, and I was watching Shark Tank, and I thought, why don't we create Shark Tank for minority depository institutions, where basically the outside parties that understand the mission of MDIs and CDFIs will actually be willing to take pitches from these banks and then offer capital investments, et cetera, et cetera. So we're in the process of setting this fund. We have a $100 million commitment from Microsoft, and we're working with a couple of other entities to beef up the fund even more, and we hope to launch it in the next couple of months. And then last, I will say we are increasing our public campaign and marketing work. Recently, we completed the so-called #GetBanked campaigns in Atlanta and Houston, and it's targeted to let people know you should have a checking account, a banking relationship. And we're also working with the Bank On Coalition, I think we just reached the milestone. I believe it's, Rayanne, correct me, but I think it's 100 banks that are now a part of the Bank On Coalition, or is it? I lose
not to correct you. I try not to correct you, so we'll go with 100, and I'll follow up with.
If it's more, correct me. If it's less, don't correct me. In any case, we stand behind the Bank On Coalition to make sure that consumers everywhere, customers have access to low or no fee checking accounts, and so they can become a part of the banking system.
Great. And I think that education process is so critical, and to have it in the languages that are needed for those market segments. Acting Comptroller Hsu, would you like to respond?
Yes. Yes, definitely. So the first thing that we're focused on is strengthening and modernizing the Community Reinvestment Act, because that is a core, it's a foundation upon which banks provide that financial inclusion for low and moderate income communities. I've talked about that before, so I'd like to just kind of put that off to the side for a moment. That's all under review. We had the OCC final rule last year. We're reviewing that, and I've instructed staff to consider all options, including potentially fully rescinding the rule and joining the Fed and FDIC on strengthening and modernizing it. But what I'd really like to focus on, though, is Project Reach. And so this is a project sponsored by the OCC. And, Annette, you were talking earlier about innovation doesn't have to be all about technology. I think that's right. I think what we're trying to do is really focus on the problem. Like, what is the problem? What are the needs that need to be met? What is the problem that has to be solved in terms of financial inclusion? And under Project Reach, we convened leaders of banks, civil rights and community groups, technology companies to say, what are the main barriers to financial inclusion? So what are the problems? And what are some solutions? And can Reach provide, essentially, serve as an incubator for the ideas to solve those problems? And so those problems really, they come down to a handful of where Chairman McWilliams talked about credit invisibles, people without a credit score. It is really hard to get credit, to make ends meet if you don't have a credit score. And yet, many of those Americans, they pay their bills. They pay their rent. They're credit worthy. And so how do we recognize that so that credit worthiness can translate into cash flow to meet those needs? So I think that there's very exciting work being done there. Similarly, home ownership. Everyone knows if you're going to build wealth, you have to close the home ownership wealth gap. If you want to close the racial wealth gap, you have to close the home ownership gap. And that gap has widened over time, which is really, really unfortunate. And part of that, if you peel the onion, down payment is a big problem. So there's a down payment assistance work stream. Stock. What is the stock of affordable housing? That needs to be increased. Supply and demand. You have to have that supply. So there's a work stream focused on that. So these are kind of chipping away at those problems. That obviously is not just an OCC or federal banking agency issue. That kind of spans a bunch of different agencies. And I think I'm encouraged the administration has really prioritized this as something to address. And then you've got kind of capital and for small businesses, minority depository institutions. Those are important, also just as important to kind of, you have to push on all of these fronts in order to move the needle. And I think it's exciting that there's clear recognition about what the problems are and to kind of figure out what the solutions are to those problems. I think that's how we're going to move forward. And I think that's where innovation should focus. I think that kind of mission-focused innovation is really exciting and something that we should all be encouraging.
Great. Thank you both very much. Okay, the next question. So far, the financial institution industry has successfully managed this extended period of economic uncertainty. Can you speak to lessons learned throughout this period and provide guidance on how management teams can use these lessons to prepare for the future? Acting Comptroller Hsu, would you like to
Sure.
respond first?
Yes, absolutely. And I think there's a couple of, I think the lessons kind of break out. It's helpful to come at it from a couple different perspectives. I think for us as the agencies, I think one lesson is if we have to move quickly, we can. I think that the agencies, the federal banking agencies, showed enormous flexibility and responsiveness to provide temporary relief where necessary. And some of these things are quite complicated, and they were done very quickly on an interagency basis. And so I think that's no small feat. And it really did provide room for what everyone wanted to do. Everyone wanted to help out. And I think that that's kind of taken for granted, and I think it's worth pausing on that point, that was a special thing where both the banking industry and the regulators are saying, okay, how are we going to get this done so that banks, which were well capitalized, in a good position to help, can do that. They can do what they want to do, serve their customers and their communities, and we can get the regs in a way where that we can enable that, and banks can work with their borrowers. So I think that's a great lesson, and we should not just use that in crises. We should use that for priorities where we can come together, work a bit more expeditiously, perhaps, than we have in the past, because I know we have a reputation for not being the fastest movers in this space. So that's one. The other is, I think that the ability of both the workforce, I guess the workforce to adapt and work from home remotely, basically overnight, while taking care of their families, while addressing a lot of health issues and concerns, was amazing. I think just across the board, both at institutions, at the agencies. I do think it's extracted a toll. I think that didn't come for free. I think that has put enormous stress on people, and that we do need to think through, as we do this return to office, return to normal, it's got to be sustainable. And I think there are, the lesson that we can do it is a great one. I think we have to be careful that does not become a permanent expectation across the board, because it's both not necessarily sustainable writ large, and the impacts are disproportionate across people in different situations. And I think just kind of awareness around that and talking things through and making sure that it's both fair and that we take all the benefits that we've gotten from that and put that into place, because I think it does improve productivity. There's productivity improvements that we should capture and we should utilize going forward. But I think we just need to be conscious about how these things kind of play out longer term. For the industry, I think the industry's adaptation to the crisis was impressive. But again, kind of circling back to a point I made earlier, I think we should be precise about where that credit is due, and careful about those other areas where we should just be prudent as we move forward.
I love what you said, because I'm not a runner, but if I saw a tornado coming, I would become a runner. And that's exactly what happened. Is overnight we had to transition and ask our IT departments to have 30 laptops, which had to be ordered. But ultimately we did move fast, and historically we probably don't have that reputation as being real quick to move on much of anything, quite honestly. But we did do that. And so I love that you mentioned that it did kind of push us along, and maybe we took all the precautions that we knew were necessary at the time and then figured out the controls later. But even with that transition, I think that we went into it with the right mindset. So it already had mitigated controls in place. So thank you very much.
Can I add just one thing to that?
Sure.
I think something that I think it's just assumed, but it's worth highlighting. It's because we all had a shared purpose. That goes a really long way. We were having a shared experience that there's a pandemic that's impacting everybody, that's not discriminating. The virus did not care whether you were rich or poor or in a city, and so there was a shared purpose around that, and that's amazing. I think that, to me, the lesson is where we can identify a shared purpose, we can do some amazing things, and we can do them faster than we thought. I think where things are not happening as quickly, it may be because we don't have that shared purpose, that purpose is either not crystallized, or maybe we just need to articulate, well, where is that? And I think that's kind of worth thinking through a bit, where we may get stuck on things, or where things are not going as quickly as we want.
Thank you. I love that. Thank you. Chairman McWilliams, would you like to comment on that?
Sure, thank you, Annette. And I'm not a runner either. And if I saw a tornado coming, I wouldn't even run. I would get in my car, because that's pretty much what we did last year. We took off, and to Mike's point, it wasn't just that. To be frank, it's not just that we had like a shared purpose. There was definitely a sense of, like, hey, we're holding hands here. Like, whether we like it or not, we're in this together. We want banks to help their customers. Banks want to help their customers. And if you ever need a reminder of how much we were all in this together, FASB was on board with, relaxing some of the rules on TDRs, troubled debt restructuring, for loans that were performing, because we recognized early on that bankers are going to be in dire straits trying to modify these loans that were otherwise performing if FASB doesn't give us an opportunity to relax the standards a little bit for the performing loans that were affected by the pandemic. But I will also add one thing that probably doesn't get enough attention is the interpersonal relationships among the leaders of the agencies. I have to tell you, in no point in time did I question if at 1 a.m., I think one call was actually at like 4 a.m., 3 or 4 a.m., could I place a call to another agency head and say, okay, we need to do this and we need to do it tomorrow, or the other agency head placing that call to me? And it was, I call it the regulatory whack-a-mole, which was basically trying to foresee where the issues would come and working together to address them before they actually reared their head from the ground. And really that's what, Mike mentioned, was it luck? Was it our work, or I forgot how you mentioned it, Mike. But when I think about what is luck? Luck is when opportunity meets preparation. And of course, I give all the credit to the FDIC staff, because we returned on a dime. So really, the lessons learned are agility of the bank staff as well as regulatory staff to kind of quickly adjust. I would say going forward, thinking outside the box. I remember talking to some of the CEOs who were trying to process PPP payments, and there were so many glitches in the You're chuckling. I know you know what I mean even better than what I mean. And we heard that the loans would get bogged down by the system and basically not make it through. So I know several CEOs, they basically put their most agile, most efficient teams to work throughout the night to manually feed these loans into the system, frankly, so that during the day when the volume was higher, they wouldn't get bogged by the firewalls, et cetera, of the SBA system. So agility, I would say agility on both the regulatory side and bank side. I think that thinking outside the box, and again, thinking outside of the box could be like the money bus for the Amish bank, or putting your best team to submit loans throughout the night, working the night shift, midnight to 8 a.m. Because that's the moment when you think you can get the loans through to the SBA system. And then also, I think that you cannot state enough the importance of working together. And really, Mike talked about this. The truth of the matter is everybody wanted to avoid 2008. Everybody. I mean, everybody I talked to, even people who didn't understand exactly how, what the bank balance sheets look like, et cetera. And really, everybody wanted to make sure that we address the issues that, frankly, have plagued the low and moderate income communities and communities of color disproportionately, even before the pandemic, but the pandemic only exacerbated the disparity. And so if we take anything out of the pandemic, for me, would be that together we are stronger. And, it shouldn't be us versus you, regulators versus banks. It shouldn't be, this bank versus that bank. Let's kind of think of the greater good of the United States and what makes sense for the economy. And one of your first questions was, how can we help some of the disparities and communities that have been disenfranchised. The truth of the matter is if everybody in the United States prospers, the system will prosper. And we shouldn't forget that moving forward. And I do think we have hopefully a new awakening on some of the longstanding issues in the society that if we hold hands, I am convinced we can resolve in the near future.
Great. You must have read my mind. When you said whack-a-mole, my mind immediately went to PPP. Yeah. That left a lasting impression.
Well, we all know what it was, right? We just had to make sure. We just had to make sure it doesn't come out of the ground without us being ready to do something.
Okay, the next question, which is back in relation to the pandemic and how banks have fared. Last year at this time, I think we were all concerned about declining credit quality on our balance sheets and how to modify our allowance for loan loss and really, how much flexibility we had in working with our customers. However, many banks came through the pandemic stronger than ever. We talked a little bit in our previous meeting about the community bank leverage ratio. But I would like for you to talk about concerns and observations that you may have about post-pandemic housing and commercial real estate markets and the effects on community banks and mutuals specifically. And Chairman McWilliams, if you'd like to start first, please.
I think I got your pattern. Whoever speaks last speaks first. So
yes, I'm rotation.
I'm happy to. Early on in the pandemic, frankly, I'll be honest with you, we didn't know what to anticipate. When you think about 2008, 2009, the run up to the crisis, one could argue should have been foreseen, right? The loan quality wasn't there. The housing market was out of whack. These loans were ARMs that were only underwritten for the first 3 years, et cetera, interest only. So, presumably, if you look at things in a vacuum, you could have potentially foreseen the impact of 2008. Maybe not the scope, but the impact, or at least that things were not right. So here we had kind of the opposite situation of that: high liquidity at banks, high capital, solidly underwritten loans. And then the pandemic happens, and something that has never happened in the United States before, which is the economic activity shutting down. Basically, you shouldn't go to a grocery store. Most people ended up ordering, many people, I don't want to say most, but many people ended up ordering stuff online. We stayed in our homes. We didn't, I remember going to Costco and looking like a ninja, all, covered up with double hats and double mask, and only see my eyes. And I'm thinking that's a perfect cover for the Fdic chairman. Can I continue this for the next 3 years? So when we think about the impact, the suddenness, the shock to the system, that could not have been foreseen. And so we frankly braced ourselves. What will happen? What will happen to the economy? Are we going to have banks fail? Back to Mike's point about being a little bit lucky as well as prepared. It didn't happen. Part of it was that there was ample liquidity and capital at banks. Part of it was that the government provided unprecedented stimulus and stimuli in different rounds to the small businesses and individual taxpayers and people with no means. And part of it was that regulators took unprecedented flexibility and did it quickly, right? So I would say it's a combination of those things that led us to where we are. If you asked me this question a year ago, we had a 33 or 34% GDP drop on an annualized basis in Q2 of last year. And so if you asked me this question last year, I would say, well, we're buckling up and we're waiting to see what's around the corner, right? Mm-hmm. We closed 3 banks during the pandemic, 3, okay? And none of them because of the pandemic. So that tells you that the banking industry withstood the shock in an incredibly strong condition. If anything, with the influx of deposits, we had about $3.3 trillion of new deposits come to the Fdic. And I think I will ask every next chairman that comes to the FDIC, did you get 3.3 trillion deposits in 1 year? Because I did. We got this unprecedented flow of deposits to the banks that frankly ended up skewing our deposit ratio that now fell below the statutory mandate, but not because there's no money in the fund. The DIF, the Deposit Insurance Fund, has close to 120 billion in it. So all of these things, I would say, were unpredictable. The consumer behavior was, all of a sudden people started saving money. All of this money came to the banks primarily because of the government stimuli, et cetera. So to Mike's point about complacency, along the crisis month into month, we kind of started releasing that seatbelt a little bit, like, okay, we can breathe. This is not going to be catastrophic. Hopefully it's not catastrophic. And then more economic data came in where we're like, okay, all right, we're fine. So I would say that I wouldn't say that we have completely taken off that we have completely unbuckled, but we are at a place where we're actually more comfortable with the economic data, how the system has weathered the storm. But, we do have concerns about certain areas, and I wouldn't say they're not imminent concerns, but we know, for example, how commercial real estate fared in the last crisis. We want to make sure that now with this new hybrid work from home, work in the office environment, and also more employees being eligible for telework in so many companies, what's going to happen with downtown real estate, commercial real estate. Some of it is being repurposed, but is it being repurposed enough and fast enough to still make the payments on these loans? So I would say that we're monitoring things. We're also looking at the home prices. I don't know. I'm sure your neighborhood is just like mine, where these tiny little homes are getting multiple offers, and it's a complete fixer-upper, et cetera, et cetera. Actually, people are looking for the fixer-uppers if they can find them, and they're selling for unprecedented price. There's a shorter supply, so we're trying to see are the housing prices going to continue rising? What does that mean? Is it an indication of a bubble or just the shortage of supply? We know that the underwriting standards are strong. We're grateful for that. But we also know that that's creating disparity for homeowners versus non-homeowners. And we also know that the biggest biggest asset that one has, most people have in their life is that home. And that's how you pass equity to the next generation and build generational wealth. So we're looking at all of these things. And I would say we're not going to, completely unbuckle. But we are breathing comfortably, knowing that banks are well capitalized. They pass their stress tests, et cetera, et cetera. But we do want to be cognizant of these issues, and again, the malls could still appear their little heads, and we just want to make sure we know what we're doing from a regulatory perspective.
Great. Thank you for your insight. Acting Comptroller Hsu, would you like to respond?
Sure. I think it comes down to three things. One is beware of the headline numbers. First. Second. Look at the segments. Look at the peel the onion and look at the segments. And third, this is like 101 for risk management, beware of concentrations. So I think, and just to unpack this a little bit, I agree with Yana. I think the headline numbers look good. I think the headline numbers are comforting in terms of the overall, whether you say levels of capital or kind of trends of various sorts. I think what is very interesting is if you unpack the headline number, the distributional impacts are quite wide. So in some areas, you see strength. In other areas, you see weaknesses. And I think this was really highlighted by the pandemic. We used to have these letters to describe the recovery. Is it a V-shaped recovery or a U-shaped recovery? I think McKinsey had come up with like 10 different letters of the alphabet to describe the shapes of the recovery. And I think what emerged at the end, it was K-shaped. There were winners and there were losers. And the aggregate kind of hides that a bit. And I think that that's very important, is that the aggregate headline numbers may look okay, but if you look under the hood, it's impacting different industries, different populations, different geographies differently. And it's important to look at that. because, which gets to my third point, if there's a concentration in some of those, that's something to be careful of. It's not going to be a financial stability concern. It's not going to take on the banking system, but on an individual bank by bank, community by community basis, that's something to watch. And I think that that's something we've been trying to just not get lulled into too much of a sense of comfort in terms of just the headlines. You got to unpack those things, and as always, be aware of those concentrations.
Right. Thank you. Well, I've been told we only have a few minutes left. So there is just a few questions here, but one in particular I think all of us are interested in. Both the FDIC and the OCC have established offices of innovation. Can you talk a little bit about what's in process there, what we can expect in the future? And I'll let you guys decide who goes first.
Mike, you can go first. Let's follow the pattern.
Okay, we'll follow the pattern. Yeah, so the Office of Innovation here at the OCC was established a while ago under Comptroller Hsu at the time, and the focus was and still remains on responsible innovation. And I think that this really focuses on recognizing that innovation is very, very important. It's not something that, almost by definition, it can't be managed. It's a process that's responsive and is experimental in some ways. What we're focused on is making sure that it's responsible. Increasingly, I'm thinking that it should also be mission-focused. I think that kind of having a purpose to the innovation is important. I hear a lot of bankers and others, fintechs, talk about how innovation can help with financial inclusion. I think the FDIC is doing an event on this later. That is fantastic. I'm hugely supportive of that. And I think what's nice about that, it gives us a benchmark to say, is this working? Is this working for us? Otherwise, just to have another app or another thing that's great, but why? Why are we having that? And I think that's a really important part of the conversation, element that needs to come into the conversation. Obviously, there's innovation happening in a lot of different places, and I think just trying to keep up with that has been a challenge. I think it's good to just be very open to all these different developments, but at the same time, just laying out that we're going to make some decisions. We need to make some decisions about kind of where things fit with regards to the regulatory perimeter. And that's something that I've signaled before that I don't think the OCC can or should do by itself. I think that's something that we need to talk about with other agencies. A good example here is on crypto. I think that I think it's been talked about publicly. OCC, Fed, FDIC are engaged in a process right now amongst the agencies through this crypto policy sprint to try to get to some a shared understanding of what the issues are and try to make sure that we're on the same page so we can respond affirmatively to these developments, which have been quite fast. I think that's probably faster than most people had expected. That's just one example. There's others out there, but I think that kind of frames the overall approach that we've been taking.
Thank you. Ben McWilliams.
Sure, I see we have a minute left, so I'm going to try to talk faster than Mike. So I can squeeze more words in a minute. Really, the Office of Innovation at the FDIC is something that I think has been long overdue for this agency, and here's why. We have got to think about how our community bank is going to survive. We have got to think differently about that last mile of unbanked customers. We have got to think differently about the resiliency of our system, the cybersecurity, how can technology help there? And frankly, there's the fourth component we have to think differently about. How are we going to ensure that the American financial system and the regulatory framework around it remain the foremost in the world? I joke I didn't come to the United States for the United States to be number two. So thinking kind of a competitively in the long term, future, the 21st century will be the American century, and how can we utilize technology to help our financial markets and then lift the people at all levels. So I do think that, those are kind of the four prongs of our approach to innovation. the FDIC took 2.5 years finding the chief innovation officer. I wanted somebody who's not a lawyer, not a regulator, who has actually, done kind of the computer work behind it, the drafting codes, et cetera, who started companies, understands the regulatory framework, but is not bogged down by, oh, we shouldn't do this. And so we finally found that person. Sultan Mekji has joined our office in the last few months. And if you ask him, he's planning for a bank on Mars and how our examiners are going to examine that. And for now, I just want to kind of lower the expectations a little bit and say we're going to focus on what can technology do to reach the last mile of unbanked Americans that need to become a part of the financial fabric and have the system work for them, on thinking about the resiliency of the system, not just cybersecurity, but in general resiliency of the system going forward, as well as how can we amplify what's already being done in the system by the use of technology, so that we have better cost efficiencies and economies of scale, especially for community banks, mutuals, CDFIs, et cetera. And then the last one is the competitiveness of American system and the regulatory framework. So with that, I will say stay tuned.
Great. Thank you so much. And I love your energy, your enthusiasm, and your commitment to the mutual banking charter. So thank you very much for your time today. We appreciate it.
Thank you. And thank you, Mike. We'll do this. We should take this on the road, you and I.
Let's go.
Thank you so much, Chairman. Thank you, Acting Comptroller and Ms. Russell. What a great session. I think we have a lot to live up to. So thank you so much. I just wanted to point out to some folks who may have asked some questions. There's a couple questions that came into the box that were supervisory specific questions, and so we will certainly answer those in the regulator sessions this afternoon.